Welcome everyone to this webinar on IRRD. Why, what, why and when? This is an interesting topic where we in the AAE have been gathering more people around this topic, also been active on responding to the regulatory and supervisory work, and we will do so for a couple of years. Now, today we will have a 2-hour session on this topic, and we will certainly try to build more understanding on what does this mean in the EU, also in a country sense, and also ask questions and try to give you food for thought, ideas, also tools to better deal with this and understand this topic. Today, this will be a 2-hour session. I will say a couple of words in the start, but after that we will have Mike Claffey from Ireland talking about pre-emptive recovery plans, and then as a keynote speaker, Arjen Prinsen from the Dutch Central Bank will talk about resolution of failing insurance and reinsurance entities. And then I will give a presentation on IGSs and the harmonization ideas in EU. And then in the end, we will have a Q&A moderated with Stefanos from the AE, who's the senior actuary and project manager there. Please be active. There is a Q&A for us to deal with all the topics. You please try to type in your questions. Stefanos will pick those up, and we will certainly deal with most of these during the Q&A. We have a quite large amount of participants, 240 people. So there will be, hopefully, we might need to pack a little bit your questions also. But anyway, please stay active, stay in the end. We will certainly do our best to respond and give a good discussion around topics you might raise. Just to kick this off, we as actuaries have been dealing with Solvency II, ongoing business. We have also obviously dealt with scenarios when it comes to solvency dropping below SCR. We have dealt with different contracts when it comes to, say, subordinated debt, benefits to our customers, shareholders, and so on. So I think the idea of crisis flow is quite clear for us. Anyway, now what the IRRD is bringing is it's defining more in a more clear and more specific way on what needs to be on the preemptive recovery plans, what resolution means, and then obviously giving a lot of tools when it comes to the resolution of insurance companies. But then when it comes to IGSs, the far end of this process, we have national solutions, and we will talk about these initiatives today. But so today we are certainly trying to talk and build understanding on the new stages and regulation when it comes to this crisis flow. This we will start by Mike Claffey from Ireland. He's a principal and consulting actuary working in Dublin at Milliman. He has been at Milliman for 20 years. Before that, also in other activities. Mike is active in the AAE, in the insurance committee, and now will be chairing the work on the IRRD. Mike has a wide experience on this topic. We are happy to have him starting and talking about the preemptive recovery plans. Mike, the floor is yours.
Thank you, Lauri. I'm just going to bring across my slides. Apologies, a little rusty. Okay, so hopefully you can now see some slides from Mike. Good morning, everybody, and welcome to this webinar. I'm going to give you an introduction very briefly to the IRRD, and then I'm going to set the scene for Arjen to talk a little bit more about resolution. But what I'd like to talk about this morning is some of the elements about recovery. These slides will be available after the webinar, and you'll notice we all have put some links in them. So the links are also available to you to do some research, to find more information on this topic. This morning, with such a wide audience, we feel like some of this needs to be educational. So for some of you, this is going to be the first time hearing this topic. But actually, we're very excited for the Q&A because some of you are very good, deep technical experts. So also we need to keep the technical people entertained and give you some information that we also have from this working party. So the IRRD directive was published almost a year ago now, just over a year ago, and it'll be effective from 30th of January 2027, so 11 months to go. It's going to be a minimum harmonization directive all across Europe, so we all have to enact it into local law through a variety of different mechanisms, but then it will be a common regulatory standard for all insurers and reinsurers across Europe. Its ambition is to establish new tools, and we'll talk about tools, and new mechanisms, and we'll talk about mechanisms. And they have two ambitions. Firstly, to reduce the likelihood of an insurance failure. And then secondly, to mitigate the impact in case a failure actually finally happens. And there are two components of the idea of preemptive recovery planning and the idea of clear resolution. But the second thing that this does as part of European legislation is it encourages coordination and cooperation amongst authorities. And as we are a cross-border industry established by the passporting regimes now almost, 40 years ago, this is an important European project that we coordinate the single market. EIOPA has had a focus on the Solvency II review over the last few years, but in parallel, it has a focus on the IRRD. And over the rest of this year, it's going to keep developing new instruments, specifically the technical standards, the RTS and ITS. And they're the things we will keep an eye on in terms of the detail, but then also for national regulators and supervisors, guidelines. And guidelines is how it'll feel in your country for you. There's also a need for some of the resolution work to build a framework for cooperation agreement for resolution authorities, but more of that later. So at the bottom here, you can see there's this real batching system. This is a very, very small slide, but it just shows you how busy working groups are on this topic. Red means they've been published, and the actuaries and the working groups in the AAE have been busy giving feedback to EIOPA and the European Council on a variety of different detailed points on the IRRD. And this was my slide on Sunday night, which was very nice. And then we come to work on Monday morning, and we discover that actually EIOPA has just released 5 major documents. And I'm going to apologize up front. We have had a very quick scan. I'm not in a position to tell you anything insightful yet on these. Indeed, if some of my technical people in the audience have some excellent Q&A points to make, we'd welcome them. But here you can see literally very hot off the press. I actually discovered these Tuesday, not on Monday. Draft RTS on preemptive recovery plans, on the criteria for recovery planning requirements, more on the resolution plans, and then this idea of critical functions. Be careful, under resolution planning, a critical function is something that's important for society. For example, third-party motor insurance could be seen as a critical function, slightly different from the definition we use in Solvency II, which is about people. Guidelines on assessment of resolvability. Arjen might touch on some of these topics, and guidelines to remove impediments to resolvability. And again, a lot of this topic around resolution is going to be very structural. A lot of the things about recovery is going to be very risk management. And we're going to try and bring that out again today. So just to give some of the audience an idea of the timeline, as I said already, the actual directive at European level came into force in January 25. Each member state has 2 years to bring that into local law and enact it. So at the very right-hand side, the deadline for the start of IRRD is 30th of January 2027. Within that period then, and here this is just a very high-level piece, this one is quite busy because a lot of the IRRD is new. In parallel, the Solvency II review It's actually more about refinement and updating and recalibrating, so a little more usual to actuaries across Europe. So a lot of new information and new ideas to get to understand and to think about under IRRD. And again, part of the objective today is to bring that out. We felt it would just be useful to give you a very quick top-down picture of how the IRRD works, because when I first encountered this, it felt unusual that two quite different concepts were pushed into one directive together. So a preemptive recovery plan is something a risk management function does in an existing insurance company, and it's part of the risk management system and part of the overall governance. And in the directive, the IRRD directive, it defines that for you. So it tells you what must be in it. So there is a bunch of requirements and headings, and I'll touch on some of those later. It needs to be shared with your supervisor. And in fact, the supervisor in the current directive said the supervisor must review them. So again, not an option. So we're going to be very interested to see how the supervisor in each local country will actually deal with that responsibility that they must follow through on. So the preemptive recovery plan is about establishing what they call, for a threat to solvency or a threat to viability, you have to re-establish yourself to be, again, a viable or a solvent insurer, and just the actions you'll take in that scenario. But part of the structure and the way they do that is they ask you then to self-assess. They call it the feasibility assessment against adverse scenarios. So you kind of think about what you might do when you're in trouble. You then imagine ways that trouble could appear, and you test your theory against those, what they call adverse scenarios. And again, we'll touch on some of that a little bit later on. Because this is European legislation, there is a requirement for coverage. And the coverage for preemptive recovery plans in each country is that 60% of the market must be actually covered by preemptive recovery plans. I'll define market in a minute. I'll just do it together across resolution and recovery because it's the same definition. So that's very much in fitting with risk management thinking. Some of you might realize there's already something in Solvency II called a recovery plan when you're actually breaching or in non-compliance with your SCR. So again, should be quite a familiar concept. Perhaps some work needed just to put your paperwork in place, to do your own feasibility assessments, and to engage with your local supervisor. And then there's quite a different structure. Resolution in the directive defines quite a lot initially about the idea of resolution authority in each country. And again, each local country has to decide how to achieve that. Sometimes it might be the insurance supervisor, sometimes it might be a separate authority. And then the directive defines what they call tools. And these are ways really that once an insurance company is decided is not viable and needs to be resolved, there's 5 different mechanisms of how you may achieve that. And then also there's quite a careful section on when you actually get pushed or pulled or fall into resolution, because it's not black and white what that trigger is. And again, I think Arjen might give you some interesting thoughts on how to begin to think about how that might occur. So far, most of this activity is actually for the government and for the regulator. The insurance companies themselves aren't necessarily involved. But part of the resolution directive components also talks about what they call powers. And in shorthand, and I think in the Dutch market where they have used these sorts of ideas, it's sometimes shorthand things like, for example, claim write-downs of how much money may go back to policyholders from a resolved or an insurance company being resolved. So again, a lot of detail in there. So from a lawyer point of view, from a national point of view, from a legalistic and from a compliance point of view, a very lot of new thoughts in resolution in the IRRD, and very important to be aware of what's there. It also then is very practical. So one thing that's very common is how to deal with cross-border. So there's an idea of a resolution college, very much like a supervisory college. It talks about information exchanging across border and across resolution authorities, because they may or may not be the supervisors. And indeed, it talks about information sharing between insurance supervisors and resolution authorities within a country. And again, all that preparatory work that's needed if and when any country has to put an insurance entity into resolution. And the other big topic and an importance that links all the way back to what Lauri will say later is that this is not a free exercise. The resolution authority has a cost of running itself. It's always there. It might not always be active, but it actually will have to be funded continuously. And then when it is active, when it's dealing with an actual resolution case, the funding of the resolution itself often includes a lot of legal fees, and then funding the cost of the tools and triggers and powers. So their decisions they make and how they fund those. So some countries are aware of these things, that a insurance company may be bailed out, and then there may be a levy on the insurance industry following that to fund the government bailing out an actual failing insurance company. So again, funding, very important component of our industry and how it sits in each national system for insurance. And just in terms of then the scope, it's a 40% scope of the market. So each resolution authority has to think about 40% of its market and plan as if it might have to resolve them. And that preparatory work, again, is to be seen how that will work in practice and how much effort that would take. So a quick bridge over to the link between Solvency II and IRRD. In Solvency II Directive, in Article 138, there's a thing called non-compliance with the SCR. So effectively, if your own funds is less than your SCR requirement, we would call that here in Ireland technically insolvent. We use a subtle word. And then immediately the board has to communicate to its supervisor a realistic recovery plan. It has a certain time period to prepare the plan and a certain time period that the plan may be effective. And that's basically what we would call here a breach of SCR. Effectively, what are you going to do to get back to be solvent? There's a slightly shorter timeline if you also breach the MCR, but effectively the same language, a realistic recovery plan is required. I jump then to the IRRD, and it's subtle. It asks for a preemptive recovery plan, which some or all insurers may prepare as part of the risk management system. And it's done when you're solvent, it's done when you're financially viable, it's done when perhaps you're having a wonderful time and are very successful. And it is defined in the directive to contain measures to be taken by an undertaking concerned to restore its financial position where that position has significantly deteriorated. So it's a kind of like a fire drill as distinct from an actual fire. And it makes a connection back to the Solvency II Directive under the governance requirements. So it links back to Article 41, Systems of Governance, which just says this is an important way to run a modern insurance company in Europe. My words, not the exact words of how they refer to it in the directive. I think that's useful because some people, including me, used to confuse those two things. So really, a preemptive recovery plan is much more about your governance systems and your risk management systems. So now I'm going to talk a little bit more deeply about recovery plans and then prepare to hand over to Arjen, who's going to do more on resolution and activities around that. The first thing is the supervisory authority in your country will have to identify the insurers that are in scope. And if it's a preemptive recovery plan, because you have to do that work as the insurer, they'll communicate to you and say, hey, you're in scope. And for example, I work in Ireland. I happen to know the Central Bank of Ireland, which is the insurance supervisor, is beginning to draw up its own map and trying to make sure it covers the 60% requirement for recovery plans. The same team is also looking at the map for resolution plans, and they're thinking about a variety of different factors. So for example, size, business model, what they call economic importance. And that can mean things, for example, if you're a unique provider of a product that's very important for your society. You know, for example, lots of professions need different sorts of insurances, or the public need coverages for their houses or their cars or their health. So again, this idea of big players in important products is taken into the consideration of who should do a preemptive recovery plan. And this idea is substitutability. That means if one company is doing most of the insurance in the company, it's important in the country, it's important because it can't be substituted. But if there's actually quite a free market and lots of suppliers, a little less pressure. And this idea of interconnectedness is very much part of how things link together between, for example, insurers and reinsurers, or for example, industries and insurance companies and the government itself. Anybody who studies a lot about health insurance gets this idea of how interconnectivity might work. That's just an example. And at least 60% of each local market across all the European countries should be subject to preemptive recovery planning, i.e. they should get a note from their supervisor to say, congratulations, you're in scope. Please prepare your preemptive recovery plan in line with the IRRD. I'll talk about the 60% on the next slide. The IRRD gives you a definition of a structure and the contents. So there are titles there. You just follow down the titles. And the other thing is that there's a group version and a solo version. So across Europe, regulators are talking to each other to coordinate who might have a group one and what that might mean for subsidiaries and who mightn't. So the ultimate parent undertaking a group may have to draw up a group preemptive recovery plan for its group, not just its head office. And then it will have to actually probably realize that it'll have to have a combination of solo recovery plans for each subsidiary, but then the collective of what it'd look like at an ultimate parent undertaking and what that might mean. So again, this is a new world. We haven't had something that has been this ambitious and cross-border. We do have group supervision for Solvency II. So again, something to keep in mind if you're part of a large group in Europe. And it's there, the preemptive recovery plan will be assessed by your supervisory authority. The directive suggests that the company itself reviews them every 2 years. There's no way a supervisory authority can review all its preemptive recovery plans in 1 week. So we imagine there's going to be some sort of phasing and some sort of seasonality to looking at so many each quarter or each year and trying to work through them as best they can. So again, an excuse if you're working in an insurance undertaking to try and begin to have a conversation with your supervisory authority of what their plans are. I wanted to just set up again that definition of resolution planning, not to give you the detail of it, but just really to describe how different this is. Resolution planning, and I call it the resolution doing. So resolution doing is if anybody gets into distress, what the regulator, what now the resolution authority and what the government would do in that situation. So really it's the planning to seek to prepare to a situation where the company is non-viable, has no prospect to become so, and resolution is in the public interest. All of those words matter. If resolution is not in the public interest, they just quietly liquidate or put it into administration or let it fail by itself. But if resolution is in the public interest, they'll pull it into a resolution planning system and then use those mechanisms to do something about that. So again, this is quite a political statement. It's going to be very interesting to see how they adjudicate to this and how it works. But again, a lot of mechanisms behind the directive to do with resolution to get all these structures in place. So the idea, the planning will be managed by the resolution authority in each member state. That's why it's going to be a permanent authority. So even if it's not busy on an actual resolution, it will be busy on the planning. Some insurers will be selected based on their criteria, taking into account the necessity to achieve resolution objectives and the undertaking's size, business model, risk profile, interconnectivity, substitutability. So again, this idea that's very similar to recovery, but actually slightly different because it's resolution in the public interest. And here they're looking at 40% coverage of the member states. And these will lead to perhaps confidential authority only known preemptive recovery or resolution plans. Perhaps actually a company might know if it's scope to a resolution plan or may not know some of the detail, or in other countries, perhaps it'll be cooperative and the insurer may know that they're very much in the planning phase of a resolution plan because their resolution authority is working with them in cohort and in, they need a lot of information from the insurer, so they might cooperate quite a lot. So again, another interesting question on resolution is how much visibility companies will get in each country. Again, in parallel, an objective is to make this a European-wide cross-border directive. So member states will also have to coordinate with each other resolution authority. And there's a concept called a resolution college. And then linking to that, some member states who have a head office of a large group may have to think about group level resolution and how that might apply to subsidiaries with local resolution authorities as well. So again, a kind of a hierarchical cross-border map to be thought about. Okay, I've been teasing you for a while on the 40% and the 60%. So firstly, recovery planning has to be 60% of the life market measured by gross technical provisions. Life actuaries like their balance sheet. And the non-life market, the 60% or the 40% is based on gross written premium. Non-life actuaries like their exposures. So very, very crudely, one's based on premiums and the other one's based on TPs. And that gives you another instant actuarial dilemma. If you need to get 60% of a market, it's easy to take some of the very biggest balance sheets and some of the very biggest gross written premium companies, the biggest companies, but are they the most risky? One to discuss at a later point. Now, I'm giving you head count and company count of companies across Europe here, just to show you the kind of the rough size of the ambition here. So there's 2,300 insurers and reinsurers across Europe, and here the colors show the differentiation between life, non-life, and reinsurance. And then if you're interested in your country, this is the number of authorized insurers, reinsurers in your local company. Shout out to France, that has a huge amount, and shout out to Germany, that has the second highest amount. Again, if you're very familiar with the French and German market, a lot of insurance companies here might be small mutuals, friendlies, these kind of other unique small undertakings in those countries. So again, headcount isn't always the same as premium volume or balance sheets. But again, it begins to show you the scope of the challenge ahead of the 27 regulators across Europe and up to 2,300 insurance companies being in the scope of the IRRD. Okay, so now a little bit just on the structure. This is taken straight from the IRRD. A preemptive recovery plan is quite simple. It has a bunch of titles and you just fill out the text below. So a summary of the key elements of the plan, a description of you, the undertaking, or you, your group. Again, remember the description is probably going to be keeping an eye on what is important to recover, what these idea of critical functions might look like, what the idea is on a resolution authority thinking might be useful in terms of what they call economically important or socially important. So a framework of indicators, this is the mechanism they really use. They kind of say that here's what will have to go to be triggered to begin to get me waking up on thinking about getting closer to using a preemptive recovery plan. And then a governance around the plan itself, both to maintain it as business as usual and then to activate it and run it if any of those triggers actually light up for you. The triggers light up is the idea. And then you have already got a bit of a playbook, what they call the remedial actions. And these are the ideas you're saying, oh, I have a problem with liquidity. Oh, don't worry, I have my liquidity recovery plan. Oh, I have a problem with, for example, capital strain on my new business. Oh, I have a remedial action plan. I'm going to slow down new business and get some capital from my parent. So again, it's the A and B kind of thinking all the time, indicators and remedial actions. And the other thing against the governance and against the activity is a communication strategy. And a lot of the communication strategy is about communicating to your supervisor. It does include communications to your policyholders and your stakeholders, which is kind of a given, but that's very much about when you have to tell your supervisor and what level of detail to give. The subtlety when you get into the detail of recovery plan is this idea of viability and financial position. If I go back to the Solvency II definition, a non-compliance with the SCR is an event. That's a very mathematical, at the end of a period, you do your balance sheet, you can do it, it's either yes or no. The IRRD is wider in ambition here, and it actually doesn't define exact events that trigger an activation of a preemptive recovery plan. That's your job. It has to be specific to your undertaking. And it has therefore, to my mind, what I call a kind of a wider domain and a wider range. Your risk management team has to use all its skills to really assess what that would look like in terms of viability and financial position. So really what the preemptive recovery plan must do, it must envisage bad situations that require, and these are now quotes from the directive, to restore the financial position following a significant deterioration of that position that could pose a risk to their viability. Pose a risk could look like a forward-looking statement. Viability isn't simply solvency. It could mean other things, operational, IT, critical fallout of systems. It could also mean liquidity. So again, it's setting you up for a wider definition than just very mathematical solvency. And linked to that, insurance and reinsurance undertaking should therefore identify a set of quantitative and qualitative indicators. And that's really the core idea in the recovery planning, is that you have to find your weak spots that mean your business isn't viable in its place in its society. And those weak spots have to be identified by indicators. And that's what you have to put in place. Those indicators need to be monitoring what I'm calling those weak spots. So again, the idea of viability and financial position are very strong words in this whole area. So now I've kind of set the scene that you're trying to do this kind of self-analysis of looking for things that can be indicated. They have to be qualitative and quantitative. So actually the indicators linked to the scenarios. So credibility and feasibility has to be assessed. So there's no point saying we'll go to the magic money tree and get magic money. It has to be something that's going to be realistic and credible and likely to occur and likely to succeed. So with your framework of indicators and remedial actions, you have to kind of push yourself through thinking about a range of scenarios. And again, the directive is quite helpful and actually quite prescriptive. It tells you need to think about severe and macroeconomic ones, financial ones relative to you, system-wide, idiosyncratic stress, and combinations. So really the kind of the full toolkit of a risk manager, internal and external, slow-moving, fast-moving, all of these kind of other things. Is the largest company in your jurisdiction failing a stress for you because suddenly things happen to you that you didn't anticipate? It's all that interconnectivity that they're trying to pull out of the system to try and really work out the resilience of the industry, and you're part of that resilience within that industry. So the requirements in respect to the framework, there has to be qualitative and quantitative indicators. They have to identify when they actually turn on and how often they're measured and how explicitly they're measured. And then it just kind of indicate roughly what the playbook or what they call the remedial actions might be in that situation. And again, they give you some ideas in the lists. These aren't exclusive, but actually they're quite a long list. So there's capital indicators, liquidity indicators, asset quality indicators, profitability, market conditions, macroeconomic conditions, operational events. So again, quite a long list hidden in the texts here. So going to be very hard to make these trivial preemptive recovery plans, because as you read through the requirements, it is quite directional in how much detail you have to put in. Regular monitoring then must be in place. To everybody's mind and practitioner's mind, the regular monitoring should sit inside the risk management system you have already. To have this as a competing and separate system just seems non-viable or silly. So again, the monitoring probably is going to fall more to your risk team and your risk managers. The remedial actions, you might think there's going to be quite a lot of detail in the directive, but there isn't, especially when you read the resolution, because they are very explicit on the tools for resolution. But for remedial actions, they're saying to the risk managers, look, that's your job. So from my mind, if you're beginning to think about this, it seems very sensible to group it into things that increase your assets if you have an asset problem, things that reduce your liabilities if you have a liability problem, things that address or change or decrease your SCR if you have a capital problem. And these are very generic. They're not in any way priority. This is just, to me, a very mechanical way of looking at your balance sheet as a way in to begin to think about what it would seem like for remedial actions. And then the fourth item might be something unique to address the scenario that actually you have failed. And for example, liquidity might be one on this that people don't instantly think about. In our experience in Ireland, by the way, I should say the last bullet point here, Ireland, the Netherlands, Belgium, and Luxembourg already have various recovery plans in place. So these might be helpful in developing. In Ireland, shareholder injection is by far the most common thing that you'd see in terms of a remedial action. And then other things that are more radical as closure to new business is never an instant thing or a one-way thing. Sorry, it is a one-way thing. It's never a trivial thing. So again, once you begin into these details, you'll discover part of your ORSA thinking is going to be very helpful, but being very specific is a bit of a challenge. It's kind of like ORSA 2.0. It's a little more detailed than your ORSA needed in preemptive recovery plans. And really, this is my picture then, that the way we used to let insurance companies that are regulated run was you'd have your business plan. You'd kind of use an ORSA to assess your business plan. This isn't exactly how it's presented, but it's the way I like to think about it sometimes. And then sometimes the ORSA will influence your business plan, and you'll have an adaptive business plan because you're kind of keeping an eye on business mix, or you're keeping an eye on something you've identified through your risk management system in ORSA. What we're now saying is a tiny little IRRD there in the bottom arrow. What you now need to do is do all that work, but then go into bad thinking scenarios and then say, well, actually, if we did pick the wrong strategy, how do we recover out of it? And that's really what recovery planning is trying to do. This is my language. You're trying to prepare for the wrong strategy when you figure it out later and pull back. So really that's what recovery planning is, preemptive recovery planning is. And then resolution is really when you failed completely. And if this was a house, it's when you're giving the keys back to the mortgage provider and saying, I'm sorry, I failed. Can we just discuss that, please? So again, resolution is the one way to terminate an insurance company. And that's really how I'd put all these together to try and see how they work within your risk management thinking. So my final thoughts really are, and I'm taking a quote from some of the EIOPA information, crisis prevention is way less expensive and more effective than crisis management. So anything to do with preemptive planning, preparatory work is valuable. But then also it's not in isolation. Recital 21 of the actual directive says existing tools may be taken into account when preparing preemptive recovery plans, including your ORSA, your own contingency plans, your own things to do with IT resilience, and liquidity risk management plans. And my final point is that the IRRD is minimum harmonization. It says at least 60%, at least 40%. So actually national variations may occur, and we're going to be interested to see how that rolls out across Europe from next January onwards. So with that, I'm going to remind you the slides will be available, and we've given you lots of reading there for the curious. And with that, I'm going to hand back to Lauri, if that's okay.
Thank you, Mike. Really interesting presentation, and you certainly talked a lot and gave us an understanding on the preemptive recovery plans, but also IRRD in a more sense. And I think with that, let me just share the screen, my screen once more, and I will introduce Arjen Prinsen from Dutch Central Bank. We are really glad to have Arjen talking to us about the resolution of falling insurance and reinsurance entities. As Mike told, in some countries there has already been activities in the IRRD sense, and certainly Netherlands is one of those. Arjen has been working for 15 years in the Dutch Central Bank in different roles, now as a senior resolution officer. Before that, he worked in Fortis and ABN AMRO. So I think we really have a best person now here talking about this topic, and glad to hear the experience and the thinking around resolution planning. Arjen, the floor is yours.
Thank you, Lauri, for your introduction. Let me. It's not very often that I have the opportunity to speak to so many quants, but yeah, don't be afraid. I'm not going to use much formulas in this presentation. I'll try to share my screen now. If it's there, yes, it is. Instead of showing you all kind of formulas, I'd like to provide you with some insights on the resolution part of the IRRD, the second R in the IRRD, and focus on some subjects that may affect you as an actuary. I have to warn you, I'll be able to talk for hours on these subjects, but fortunately for you, my time is limited to say half an hour. First of all, I'd like to start with some background on the IRRD, or on the resolution framework in the Netherlands. In the last decades, we have seen some failing insurers as well as some near misses, and in some cases these have been solved by the market, by for example takeovers. But during the financial crisis in 2008, banks, insurance, and bank insurers were supported by government funds or even nationalized to retain financial stability, a bailout, so to say. And after this, firstly, the BRRD was initiated for banks, and in 2019, in the Netherlands, the Act on Recovery and Resolution of Insurers came into effect. Making it allowed DNB to resolve a failing insurer using bail-in instead of bailing out. So that's 6 years ago now. Last year, the IRRD was published, which will be effective next year. This IRRD is quite similar to our Dutch national framework. There are a few significant differences and many small differences, but I will not dive into those differences now. Before I'd like to, I take off with the actuarial part, I'd like to mention some the resolution objectives and conditions for resolution, to keep them in mind. The resolution objective include the protection of public funds and financial stability, but it's also the protection of collective interests of policyholders and the continuation of critical functions, which Mike told you about previously. These objectives have to be kept in mind when applying resolutions, of course. Before applying any resolution measure, an insurer has to meet the conditions for resolution, of course. This means that the insurer must be fail or likely to fail. Secondly, that there are no reasonable prospects that private sector measures or supervisory actions would prevent failure within a reasonable time frame. And as resolution measure may affect property rights of shareholders, creditors, and policyholders, which are deeply embedded in the Treaty of the European Union, resolution of an insurer must be in the public interest as well. If resolution would not serve the public interest, normal insolvency proceedings shall be applied. And there I would mention that actuaries will have an important role, of course, in determining the conditions for a resolution. As resolution should serve public interest, I'd like to mention some of the benefits a resolution may have. I say may have, as these benefits may depend on the circumstances of the case and, of course, which insurer it is. First of all, it may ensure the availability of important insurance contracts, the critical functions Mike also mentioned. If the failure of an insurer would result in the absence or shortage of certain important insurance contracts, resolution can ensure that the continuation of the portfolio and the availability of these products for new production. As an example, one could think of a pension insurance or, for example, medical liability for surgeons and hospitals who may not be willing to operate without insurance, which would be a problem, of course, for society. Second of all, is that resolution allows for continuation of existing insurance contracts. This is especially valuable for those policyholders who are unable to take out replacement insurance, for example, because they have deteriorated health or other deteriorated circumstances. Furthermore, resolution would prevent replacement costs for policyholders when taking out a replacement insurance. So that would be a benefit for society. Resolution may also avoid economic consequences and market contagion, especially relevant for the larger insurers. For example, if pension benefit payments for a lot of pensionados would be discontinued, this would affect real economy because demand would drop. And also the unwinding of derivative contracts or other measures in liquidation of an insurer might have an adverse effect on the economy as well. Lastly, as resolution aims to apply bail-in rather than bail-out, resolution could prevent or reduce the need for extraordinary public funding to protect public interests. So that's touches the objectives of resolution, of course. Before I dive into the resolution tools and how to evaluate, I'd like to mention that the resolution decision is not an exact science. There are some criteria which we have to meet, and all those three criteria should be met before taking any resolution action. And none of these conditions are exact science. For example, failing or likely to fail is not an exact science, as likely to fail does not imply a 100% certainty of failure. So the condition can also be met if there are objective elements to support failing in the near future. Assessing measures that could prevent such failure is again not an exact science, as the outcomes of such measures may be uncertain, and also the term reasonable expectation is by its nature subjective. And then the public interest test is also not an exact science, as some of the criteria are subjective in nature and entails a comparison between two uncertain outcomes, the outcome of resolution or the outcome of insolvency proceedings. Then the resolution tools. The IRRD defines 5 resolution tools: write-down of or conversion, solvent runoff, sale of business, bridge undertaking, and the asset and liability separation tool. Beside this, the authority has been granted several powers, such as the power to assume control over the insurer, or to install a special manager, to remove or replace administrative, management, or supervisory bodies, and the power to prohibit to underwrite new insurance. There are some more, of course, but we'll not dive into this in this presentation. It's important to notice that all resolution tools can be applied individually or as a combination, except for the asset liability separation tool, which has to be applied in combination with at least one other resolution tool. Well, the first resolution tool, write-down and or conversion, I would say, is expected to be applied in any resolution case, as the resolution decision requires that there is no reasonable prospect that private sector measures could prevent failure, a situation in which writing down creditor claims would not be necessary would be unlikely. In such case, private sale or of the insurer or other recovery measures would likely be possible to avoid failure. So that being said, the write-down and conversion tool can be split into 2 parts. The write-down part and the conversion part. The write-down part is used to absorb losses and possibly to recapitalize the insurer to facilitate an end solution. One of the end solutions available would be a sale of business, which could be facilitated by write-down to make sure that the sale of business is possible under commercial terms. Another possibility would be to apply a write-down and a conversion to facilitate the solvent runoff tool. It's another end solution. Under the solvent runoff tool, the insurer under resolution will be continued without underwriting new insurance businesses, and it has the objective to terminate the portfolio over a longer period of time. That could be years in a life insurer. When initiated, the insurer has to comply with the MCR immediately after the application of the tool, and its authorization may be withdrawn, but it does not necessarily has to be this. Has to be withdrawn. That's up to the resolution authority, I guess. In case when you initiated a solvent runoff, it's also possible that it will deteriorate it afterwards. In the case of a negative equity, afterwards the resolution authority may have to decide to either use another tool, a new write-down, I would say, or to place the insurer into normal insolvency proceedings. Then another possibility for an end solution would be to pursue the insurer as a going concern. So This is especially useful for the continuation of critical functions. For example, it's a way to make sure that some kind of insurance policy remain available within the market. But it's also a way to serve the resolution objectives without the dependency of third parties, like a buyer, or in case a sale of business would not be possible. I would have to mention that this possibility might not be available in all EU member states. I will not dive into that details, but in the Netherlands, it would be possible at least. When using this tool, actually only using the write-down conversion tool, say and conversion instead of or, then the creditors and policyholders may end up owning part of the insurer. And it could be that the existing shares will be cancelled or diluted, depending on the deficit to be covered by the write-down. Then the fourth resolution tool, a bridge undertaking, as the name says, it's a temporary solution. For example, if market circumstances are such that a sale of business or other resolution tools are not possible in time. And the bridge undertaking has the purpose to bridge the period and has a and an insurance company in the bridge undertaking would of course need to be sold or restarted afterwards. Then finally we have the asset and liability separation tool. This is also a temporary solution and meant to store some asset and liabilities which are, for example, unmarketable with the aim to liquidate these in due time when market circumstances improve. And the proceeds, of course, need to be distributed to the creditors of the insurer as well. Well, now we are introduced to the resolution tools. I'd like to start with the valuation part. But first of all, I'd like to have some poll and give you some few moments to answer on your ideas on what could trigger a failing or likely to fail. Multiple choices are possible, so please fill in if you like. Give you some moments to reflect on this. I hope you all have your time to fill in an answer. Thank you. See a lot of variation here. Negative equity, MSCR bridge, and liquidity are the most mentioned things. Well, let me start on the valuation part. Valuation. Article 23 states any resolution action is taken on the basis of valuation ensuring a fair, prudent, and realistic assessment of the assets, liabilities, rights, and obligations of an entity. Valuation is very important as it serves to decide on the resolution decision and the resolution actions to take. By which, of course, the right to property could be compromised. It is also used to determine the distribution of losses and recapitalization between shareholders, creditors, and policyholders. And last but not least, it determines the compensation if resolution action cannot avoid no creditor worse off breaches, which is also one of the cornerstones of the IRRD. Actuaries may have an important role here. They could have a role as an independent valuer or part of an independent valuing team. I have to note here that as the independent valuer or the resolution authority do not have the infrastructure to evaluate insurance portfolios for a specific insurer, that could be quite complex. The valuer also needs to rely on infrastructure and capabilities of the insurer under resolution. This includes actuarial knowledge that is specific for the failing insurer, and actuarial skills are also required at the resolution authority and supervisory. Well, valuation could be divided into three parts with three purposes. First of all, first purpose, valuation 1, is an ex ante valuation to determine the conditions, if the conditions for resolution are met. So if the insurer is failing or likely to fail, or determine if there are no private measures that could prevent them. The valuation 2, also ex ante, is to inform the decision on resolution actions. And the third one, the ex post one, is to verify the basis for compensation on the NCWO breaches. Let's begin with valuation 1. These are the criteria as mentioned in Article 19. And an insurer is deemed to be failing or likely to fail if those 5 conditions are met. Here conditions A, C, and D are quite clear. First of all, is if there's an MTR breach that could trigger failing or likely to fail. And I must say that it is an MCR breach without prospect of compliance being restored. Also, negative equity, assets smaller than liabilities, is a trigger, and not being able to pay the debt due, so illiquidity. Then you also have the conditions for authorization as a trigger. That would be, again, the MCR, because as one of the conditions for authorization, an insurer should show evidence that it is able to hold the MCR. But also that it should show evidence that the insurer is able to meet the SCR going forward. So in that case, the trigger is an SCR breach could also trigger failing or likely to fail. Additional to this, you also have the elements to support that condition, and B, C, or D are met in the near future. So a deteriorating financial position is also a trigger for failing or likely to fail. That may even be the case if the SCR is still met. So if you still have an SCR ratio, say 102%, but deteriorating, it also already might have triggered the failing or likely to fail condition. However, failing or likely to fail alone is not sufficient for a resolution decision. The NRA should also determine that private measures do not provide a reasonable would not prevent the failure of the undertaking. So that would within a reasonable time frame. So simply breaching SCR or MCR alone is not enough for the decision. It should also be, so to speak, hopeless. This has the following consequences as well. Solvency, the valuation 1 should be based on Solvency II, with the reference date as close as possible to resolution decision, which is obviously afterwards. It also shows that you might need projections or scenarios to assess the objective elements to support likely to fail, and to assess scenarios to support private sector measures, to see if private sector measures may be a solution. And lastly, a definitive valuation, which should also be accompanied by an insolvency valuation, or actually to an estimate on the treatment of creditors in insolvency. Then, before I start with the second valuation, I would like to mention some remarks on the sustainability of an end solution. Of course, resolutions should result in a sustainable solution, and that makes restructuring may be necessary to remove the cause of failure, for example, and when applying write-down, rebalancing of the insurer's assets may be desirable, and risk mitigation measures may need to be aligned. Secondly, we have to realize that a healthy insurer's capital position is normally well above the SCR. So this may require a haircut that is larger than the SCR deficits or a buy goodwill. This is also not exact science, but an exact right haircut does not exist. Another insight is that the highest bidder in a sale of business does not necessarily offer the sustainable offer. We obviously hope so, but it's not certain. And then we have the bail-in dilemma, how to make sure policyholders are properly compensated for the haircut. Given that policyholders will contribute to the post-resolution capital in case of a write-down and conversion, they should be compensated for this. However, it's not easy to explain to policyholders that they have become shareholders, or on the flip side, it's also difficult to explain that someone else gets the upside for the policyholder's contribution to capital. This is quite a technical issue, and I will also mention that this would not be the same in every member state. Not every member state would allow a haircut on insurance policies. The Netherlands would. Then, on informing resolution actions. Well, the resolution actions means that the valuer should consider the consequences of each possible resolution action it's considering. This could be a sale of business, and in that case, valuer should come up with some minimum fair price, which is not rock bottom. A maximum price is not necessary because the buyer will also always be able to refuse a sale of business if they think it's not commercial. Then what is the price to pay here? It depends on your perspective. For an insurer, for a buyer, it's actually the price for the shares or the assets and liabilities to take over. plus any recapitalization needs, capital injections they need to inject. But for the policyholder and creditor's perspective, the price is actually the haircut. The haircut they pay. Then, if the write-down and conversion is considered as a resolution officer, as a resolution action, the valuer should be able to calculate what happens if an haircut is applied on policies or on other creditors, what the effects are on the SCR, what the effects are on the risk margin to go forward. It also needs to estimate some value of the post-conversion equity, so market value, to determine the conversion rate as a compensation for the write-down. So these are quite some calculations to be done, and this could have, in fact, be several calculations. For the solvent runoff, the same is valid. But there again, you also need to make a projection of the solvency, taking into account the increasing unit expenses in case of a runoff. Yeah, and one other point here is as well, again, just like with the write-down and conversion part, is that you need to determine a target solvency rate. Then, last but not least, the valuation tree. After resolution is ended, the valuators should verify if all creditors are not worse off than in insolvency. So they need to calculate the actual treatment in resolution versus the normal proceedings. And this also is the basis for compensation for NCWO breaches, which is to be granted afterwards. Here, the reference date is also an issue. It's important to know that it's the same reference date as the decision date, taking into account any changes due to incurred claims for the period between resolution and effectuation of bail-in. Okay. Then I see I got, how much time do I still have? I still have a few slides.
Yeah, please go through.
Okay. Then I want to dive in a write-down of insurance contracts, how to do it. As I mentioned before, this the write-down of parts of the insurance contracts, a haircut, would not be possible in all member states, I would expect. I'm not sure yet which do and which don't. In the Netherlands, that it would be possible. There are a few methods to reduce the policy. You could apply haircuts on the benefits only. That may work for insurance contracts with capital accumulation based on actual premiums, or for example, pension insurance, which are reset annually, or which premiums are reset annually and just build up capital. But in case of fixed premium, say a fixed premium for a life endowment of 20-year life endowment, 20-year premium period, which is fixed, this would have could have some strange outcomes. For example, because the differences between the future premium which has still to be paid, and here a disbalance between the benefits and the future premiums could appear if you only apply a haircut on the benefits. This can be solved by applying a haircut on the entire contracts, which is actually my favorite method. That would mean that the contract will be smaller. So a policyholder would say, may, for example, lose 4% of its benefits, but will pay 4% less premium. This has the benefit that, the contract from the perspective of the policyholder will be 4% less valuable, of course. The big advantage of this method is that it's equitable for all policyholders, irrespective of any actuarial assumptions or term structures. Would remark that on the insurer side, expenses will not be cut. By cutting the benefits and premiums, it will not cause automatic reduction in costs. So a haircut of 4% on the policies would result in a reduction of the technical provisions of a bit less than 4%. Last of all, it may be necessary to remove some policy options and guarantees, especially, of course, if those are related to the future profits of the failing insurer. So if you have some profit sharing scheme based on the company profits and knowing that the company failed, those would be not be continued in the resolution. Then this is my last subject in this. If you would apply a write-down and conversion, so to say a restart, you need a conversion rate. You need to calculate the rates, the number of shares you get for the haircut as compensation for the haircut. Here it's important to note that the only alternative for resolution would be normal insolvency proceedings. So the liquidation price or claim in liquidation is therefore the basis for the eligible compensation. And the compensation, because you get shares, will be an unknown market value of the post-conversion equity. So we need to estimate the market value. And then the mechanics for the allocation are quite straightforward, so to say. It follows the hierarchy in insolvency proceedings. It will compensate first those creditors with the highest rank in insolvency. If they're fully compensated, we'll go on with the second highest rank and work down the hierarchy, and up until the moment that all new equity is allocated. So this is in brief. I could talk about 2 hours on this subject alone. I won't bother you with that. I would like to close with some an overview of some areas of interest for actuaries. As mentioned by Mike, this could be the preemptive recovery plan, the determination of critical functions, all kind of calculations and valuation scenarios to be made. There's a lot to do for actuaries in resolution as well. And then my final thought, just like Mike had some reading tips, I have mine myself. On January 23, the book, The Insurance Recovery and Resolution Directive, a commentary was published by Elgar Law. This was edited by Pier Paolo Marano and Magdalena Konsinska. She's part of the Polish Resolution Authority, and I had the honor to be one of the authors of the evaluation, and I wrote the evaluation part. So if you have some time left, you could consider reading this. Thank you for your time and your attention.
Thank you, Arjen. Really good presentation, really a lot of information, and thank you for guiding us through the resolution process. I think you had a really lot of kind of good topics on the valuation, which certainly seems even assisting resolution authorities with the valuation needs a lot more than an actuary and an Excel sheet. So it certainly is a big process. Anyway, let's we can come back to maybe some of the questions and on this topic. Maybe now turning to the last presentation, which will be on the insurance guarantee schemes, and after that, let's have a word together on some of these topics. So maybe just starting with this. Hi everyone. Insurance guarantee schemes, the minimum harmonization is now part of the discussions in Europe. It's in the political agenda. In the very end, I will say a little bit on the process, but this is something that we are now building up understanding to this topic within the AAE and trying to also have discussions with the European Commission, EIOPA and other key stakeholders on the topics. So maybe a couple of words on this one. Insurance guarantee schemes, we can make a definition that an insurance guarantee scheme is a mechanism typically funded by insurers that protects policyholders if an insurance company fails, ensuring compensation or continuation of critical insurance coverage. Its purpose is to enhance consumer protection and maintain trust in the insurance market. So I think this being well, there might be other definitions, but certainly looking the consumer aspect is really strongly inherent in these definitions. One could think about from the consumer's point of view that an IGS would protect against insurance failure. I think we have similar things in the banking system already. And then one can think that if there is a failure, these could be somehow also helping on the process. And I think obviously in EU, the one of the arguments here would be that there is with the IGS minimum harmonization, there would be more equal treatment across the EU. This certainly applies on the cross-border insurance cases. Then also IGS might bring greater financial stability and strengthen trust on the insurance sector. I think these are then I couldn't say that what would be the mistrust for insurers, but anyway, more mechanism and good communication on that regard would help if there was fears or thoughts from in the EU from the EU citizens that this would there would be a lot of risks in the case of getting your benefits or payments or whatever. We do have national insurance guarantee schemes and pooling agreements already existing in EU. I tried to collect a couple of these. There are certainly more. Also, we do have pooling agreements, which might be kind of halfway also already to the definition of insurance guarantee schemes. But anyway, on the life side, in Germany, we have already a fund where there's technical reserves funded, and I think it's something like 1% of the liabilities, the target. In Italy, there is a similar thing started, and this is happening. We also have cases from Denmark, UK, Romania, where more non-life, or in the UK, case, it's quite a wide range of different insurance, but also other financial covers, and then in Romania also for life and non-life. And these have different funding models. There are some limitations. These are really crucial to think about the funding model, and I will come back to the ex ante ex post question. But also the limits are really dependent on the national needs, and also the insurance market. So sorry about everyone, and now shared. I think what I had before was the definition of the insurance guarantee schemes and the desired benefits as told. And now you have here the slide on a couple of examples of the existing IGSs in Europe. These all have quite good websites, and you can learn a lot on how these work. Anyway, let's not go to that detailed level today. Then I think when one thinks about the IGS and the role of IGS in the current framework, you need to answer a little bit on the questions on from the other hand from the consumer perspective, but then also on the public level. We know we are familiar with the insurance company setup and all the stakeholders you have there. The one point I would bring out is also that when we talk about IGSs, we might need to think about the different insurance products and the coverage and how essential these are for customers. There might be consumer protection framework already emphasizing some aspects. There might be public level coverage to some of these elements, say health, some pension products, natural catastrophe usually might have some public level protection. And even though the IGSs are separated from the public funding as the definition goes, there is still there might be expectations, there might be basic covers that should also be looked at. And therefore, there seems to be a bit of an overlap when it comes to, say, increasing the prudential regulation framework to IGSs, and then looking on what is the public and national level coverage here. But anyway, with these consumer protection initiatives, what we have a lot in EU, we have also different. I think there's an IDS for instance, the savings and investment union, that there would be more also life savings going to or more investments to EU via life savings, and then also we see the Nat Cat discussion going on a lot. You really need to think about how these initiatives could be. Is there a place for, is the IGS somehow, does it have a role here or not? What would be the actual comfort to the consumer level if there was an IGS in place, and so on? But anyway, every time when we change the prudential framework, it will all the insurers need to think about the key stakeholders, whether it's rating agency, reinsurance agreements, the connection to capital markets, and the owners. So certainly just serving consumer perspective is not you need to think about these all other aspects. These are all in the headlines. We know that there are insurance failures in EU from the last 5 years even. We have the cases like the Eurovita in Italy, the Euroins in Romania, Bulgaria, then the just really recent FWU Life on Luxembourg, which had operation in many countries, and then the Gefion from the Danish market, which already also had a lot of products sold in other markets. And these all cases are obviously difficult. There have been consequences smaller than or bigger for customers. There might have been guarantee schemes somehow covering these some of the payments there, and these certainly should be studied and learned and also improve the system so that there be less consequences for customers. But still, we are somehow struggling. I use the word insurance failure. This is not a very exact definition. We just in the kind of the presentations earlier, there have been different wordings here, and we learned that during the resolution there are really certain steps here. But sometimes when we talk about failure, do we look it from the consumer's perspective, from the insurance perspective, whether there are different stages and definitions of failures? I think this is something that one needs to be quite exact and specific. Then there seems also to be a political desire that always when there is an insurance failure or similar, there is this are somehow picked and there is a kind of discussion that whether these shouldn't happen at all, or whether there should not be a possibility for insurance to go bankrupt, or at least a possibility for a consumer or policyholder to somehow end up to having some loss. Insurance is a private business, and we do. I think in generally we accept that in private business there can be a stopping of that business activity, and that might have some consequences. But this is certainly a political discussion here, and I think one thing to certainly inherent in the European discussion. Maybe also picking up another topic, as told, some insurance contracts or covers are a bit more essential than others. There have been attempts to define this. Why this might be important is that obviously one can have an IGS that covers whatever failure there is, but sometimes to maybe make it more efficient or save the costs or whatever other reasons, you might need to define on what insurance products is actually on scope, what is the needed, say, minimum harmonization in a sense. IRRD in somehow it defines the when using the write down and conversion tools some of these national specifics and gives examples of products where say pension benefits, also some health products, long-term care that might be understood as essential when it comes to using of write down or conversion tool. Also, EIOPA has been defining this in the early work on the IGSs, and they tried to have a list on looking in what case life, long-term savings, non-life, certain lines of business might be understood as being more essential than other products. Then maybe just noting a couple of questions for what we should think about or maybe answer in any attempt to harmonize the IGSs in a minimal level in EU. There should be some kind of harmonization in key operational areas agreed on. We have intervention triggers, portfolio transferability, continuation of cover, geographical scope, really a lot of details that we need to have good answers on. Obviously, the IRRD implementation work now in each countries might already solve this a little bit, but then if it's about IGSs, these certainly need to be answered. The home and host protection conflict, that remains a really big issue, as showed in these examples of insurance failures. Every time there's a cross-border business, this brings us to questions on, are there different ways of protection in the end with customers in different countries, even though it's the same group. There are some mixed models already. We have the motor insurance directive having a kind of a hybrid model on home and host. Let's see how that works. So there might be some learnings. We need to point out also that there might be kind of a timing concern. As we heard now, there is IRRD now taking place and bringing new supervisory powers, defining the structure a little bit better. There's also the Solvency II review addressing some of the new topics, like more on the liquidity risk measuring and plans. So there might be if the expectation is that the future framework, prudential framework, works already better, would we already have done something in terms of preventing and making these possible insurance failure less likely? Then there are significant national differences that should be taken into account. This might be, obviously, yes, we can have an EU framework legislation, but when it's really on it needs to deal with national specifics, then it's quite difficult to find what is the level of minimum harmonization still to allow that national specifics to work. And then also, if it's cross-border, then we need another level of tools. Picking up a couple of other, as told, the pre-funding and post-funding is a challenge, and there seems not to be one good solution. The pre-funding ties up capital. We saw that those examples already from the life sector. Maybe we already could study, for instance, the German and Italian market, whether there's actually how much big of a problem the pre-funding is or isn't it. But then if we have post-funding, then that might be difficulties in a concentrated markets where one could ask that if a big company fails, who would pay and what might be that market consequence. One could also think about the cost of IGS. There already we saw this funding levels of funding, even though what is the theoretical price, we could think about that, whether it's I think we did some years ago some kind of simple calculations trying to look the probability of the insurance loss times the expected shortfall. Here we used different probability distributions, ended up something like 2 times 1,000 to 2 times 2 to 10,000 levels, which were really small. Obviously, if one would take correlations to wider market uncertainties and prudential level, you could end up higher costs. But the thing is that when we have Solvency II in place, and if we believe that already is the VARA 99.5, then companies are a bit above those levels, and then what would be the expected shortfall in the end? Obviously, with this type of calculation, one would end up with quite low cost, but then what would be the real and really answer to this, it would be hard to figure out. The As told, the risk of contagion in concentrated markets is something significant, and I think here we can look some of the data from EIOPA on the European life, which is on the right-hand side, and non-life, which is on the left-hand side, and we see that if you look in the column, there's the biggest top 3 and then top 5, top 10 companies. If you look the top 3 market dominance, you have already half of the market, and then even 2/3 of the market covered by the top 3 in some of the countries. And these are a bit different on non-life and life, but I think the result is that European insurance markets are really concentrated when you look the big amount of those countries, but in the bigger markets, obviously in the really down figure, you have France, Germany, Ireland, Belgium, which certainly have a more bigger amount of insurance companies, and therefore I think maybe just what you should think about is that can we have a minimum harmonization, at least if we see that the market concentration is a factor that we need to understand better, or at least count in, then how should we deal with the different levels of concentration in the EU market? So certainly one topic to solve. Just on the last slide on the future process, and then let's go to the Q&A. Now what we have is that this is on European Commission's table. They have formally requested EIOPA to provide technical advice on establishing minimum common standards for insurance guarantee schemes within the EU, and this is part of the IRRD. Now EIOPA is preparing their response. They have had webinars. There will be consultation on this one, and then EIOPA will prepare their formal advice to the Commission by end of August this year, I've understood, and then the Commission needs to think about this and come up with any legal proposals or non-proposals. But anyway, it's on their table in the end of this year, and early 27 we will get something out. So this is on the process, and couple of thoughts on the IGS. Hopefully this was useful for you. By this, I think we would be now ready to go to the Q&A, which would be moderated by Stefanos, the Senior Actuary Product Manager in AAE, and we will be all answering the questions. So Stefanos, everybody, let's take the Q&A.
Thank you, Lauri, and greetings to everyone. Picking up from the IGS, maybe looking ahead to the Commission's legislative proposal in 27. You had a wish list, Lauri. What are the 1 or 2 critical elements that must be included to make it effective, and what should definitely be avoided?
Sorry, could you repeat? Sorry, Stefanos. Yeah.
Yes, so we have the legislative proposal from the Commission coming in 27 on the insurance guarantee schemes. If you had a wish list of things you would like to see, what would the 1 or 2 things that you would consider a priority, a must-have?
Yeah, no, well, thank you for that. And this is something certainly that we are now looking there and trying to even come up with our kind of minds on what would be the prioritized. As I think there is a lot of difficulties in the minimum harmonization, and I think at least if we would, yes, it's a political decision that do we need this minimum harmonization of IGS or not, but still I think to somehow acknowledge the differences in the EU market and have proposals which would somehow not disturb too much the current market. There's so much other things happening somehow. I think there's also a pressure for even if one would look this from the consumer point of view, to have these solutions to NatCat or have these solutions to EU competitive kind of goals. So I think just if there was an IGS, then ensure that other priorities are still achieved. Thank you, Stefan.
Thanks, Lauri. Thank you. It's a delicate balance to get this right, for sure. Definitely. So implementing IRRD requires national regulators to build a significantly new expertise. And of course, the resolution authorities will need a deep understanding of the insurance specifics. Perhaps a question to the group: what practical difficulties do you foresee at the national level? Perhaps also considering cross-border insurance operations. Mike?
I was going to ask Arjen is going to be the most useful expert, having he lives this world, so he can share maybe a little of his lived experience. Let's just talk about resolution. So I think Arjen did an excellent job in showing you how much structure is in the IRRD for resolution. And actually, if you read the directive and some of the technical standards coming out, a huge component of resolution is going to be cross-border activity. They call it cooperation, they call it college, they call it a lot of things. Let me make a bridge. If you remember the slide Lauri showed for Gefion, a very nice entrepreneurial Danish insurer who had very nice European cross-border ambitions, and it failed. And the solution was different in each country. So if you actually remember the right-hand cell for the Gefion table, it showed that of the 7 or 8 countries that it was active in, including Ireland and the UK, sometimes it fell inside a local consumer protection system, and sometimes it didn't. So why am I drifting to insurance guarantee schemes with request and resolution? They fit inside each other. It's the sock without the shoe, or the shoe without the sock. So I don't know how to do it, but I think the resolution authorities are going to probably mostly succeed when they're very close to the local supervisor. Maybe not the local banking regulator who has a resolution authority, because I think it's so specific, insurance is so specific, maybe that's a success factor. So my rambling reply, maybe Arjen can add more.
Yes, I agree that sitting close to the supervisor, which we do, and to the banking resolution is very helpful, because you can share experiences, you can share also capabilities or knowledge on the thing, on insurance companies, and keep communication close in that case. Well, for new resolution authorities, I think one of the challenges would also be how to, at the same time, develop your national instruments and make sure you make them operational, and at the same time develop all kind of resolution plans for insurance companies, because you make plans. If you make plans, you need all those instruments and tools to be ready, or you have to know how to act on that. And it will not be in place for in all countries from day one. So that would be quite a burden. So it would take a while before a resolution authority would be able to actually apply resolution to it. On the point of cross-border, we do have some big insurance companies like NN, which have cross-border activity, but the cross-border resolution part is still in its child's shoes, as we say in the Netherlands. It's quite young, so we're developing all kind of colleges in Europe, just similar to the supervisory colleges. A lot has to be arranged there still. So how it will end up, I don't know yet, but it's there will be quite some similarities with supervisor colleges.
Could
Yeah,
I,
maybe
sorry,
just yeah,
I had
Mike,
one more
please.
sentence. Just, yeah, the other thing maybe to remember as a practitioner, resolution is painful and it causes damage.
Yes.
You're deciding who suffers. There will be suffering.
Yes.
So if you want to reduce the suffering of the policyholders, the government has to pay. If you want to reduce the pain of the government, the industry has to pay. If you want to introduce, so really this is about an exercise in passing out pain.
Yes, and which actually the IGS is as well. Who pays the
Yeah.
burden is always the question.
I think the word orderly resolution is the key word, making sure things don't fall apart violently. Lauri, you wanted to chip in, I think.
No, just saying that I think with the resolution part of IRRD, I think I also see quite a lot of implementation, national kind of implementation difficulties when it comes to, because it might be a new regulation on the resolution side. There is the banking experience, but also you need a lot of experience when even implementing the IRRD resolution part in the national legislation, and there might already be kind of some solutions when it comes to motor insurance or some mandatory insurance lines. There might be pools in place or some ways of kind of thinking about the how the industry would solve some of the issues that are coming, and these might already have some smaller regulations in place. So even though just saying that this is the implementation work itself is difficult, and even not going to the actual resolution if there was one.
Yes. Definitely, different jurisdictions also have different systems in place, and all the countries will not be on the same foot going into this directive. So there will be an adaptation period, I would presume. But there were a lot of questions I noticed during your presentations in relation to the subsidiary versus group resolution plan or recovery plan. And I think there's a lot of interest there in how you perhaps could passport this the existence of these plans between the two, and also depending on the market share of each subsidiary. And I think, Mike, you went ahead and answered a lot of those questions. But perhaps it would be interesting to discuss a little bit how we reconcile the group versus subsidiary recovery plans and the interactions there. If you want to say a few more things, or if Arjen and Lauri would also want to comment.
I'll try and say as little as I can just on the idea of preemptive recovery plan. So on my slide, I showed you there's 2,300 insurers across Europe. A lot of those are parts of groups. But actually, that's not a useful measure, because what you're trying to do is measure balance sheets for life companies and gross written premium for non-life. It looks like, an example in Ireland, it looks like the supervisor will quickly exclude some insurance straight away. So captives is a word we use in Ireland a bit. Captives are excluded from preemptive recovery plans. So I think the first thing is to figure out if you're in the central pool or not to start with. Secondly, I think under Solvency II, the College of Supervisors is very important, very strong, and very active. So I think for groups, especially insurance groups inside Europe, I don't know how they'll do it, but there's a very big one in Germany, there's a very big one in France, there's a very big one in Spain. Maybe those three countries will go to those big people and say, tell you what, let's do a full map here, and then I'll send a message to Ireland, I'll send a message to Italy, I'll send a message to wherever else. So it does seem very practical that the groups inside in this Solvency II system are probably expecting this anyway. So if you're a subsidiary of a European insurance group, I suspect your group is going to do it for you. There's a little bit of interest then when your group is outside Europe. For example, anybody who's keeping an eye on Bermuda headquarters, these kind of organizations, they'll be interesting. So again, what a Bermuda regulator sees as a group regulator versus what maybe some of the local countries are doing in Europe, there's definitely a spirit of information sharing. And that is going to be interesting to see how that channel gets developed and used. So that's how we deal with groups inside and outside of Europe. The local subsidiaries and the local countries will wait and see if the group is going to do the recovery plan first, and I think take credit for that and probably get a copy of it. And then only when there's a gap, they're going to go to the local subsidiary to say, yeah, I need something extra for you because your parents didn't do it, or you're this other position. Please, let's do one. I think. We should know by the end of the year, because in Ireland, the central bank is going to be the communicator on this, and it's beginning to prepare the letters it's going to send out to the insurers to say, hey, you're in scope.
Yes, and I'd like to add to this, because in many groups there are interconnectedness between all the different entities in different countries, and they may share some operational units. There may be financial interconnections. There may be internal reinsurance in a different country within the EU. So simply focusing on your own entity only in the country wouldn't help, because then you have probability that there will be contagions in your own group, which of course would not be very desirable. So it would make sense to at least have some coordination between all the preemptive recovery plans within the EU.
I think we have a question from the audience, which we can take. Not sure if you can see the screen as well, but I can read it out for you. How can NRA drawn a resolution plan for a local subsidiary, which is a top 1 to 3 in the local market, but the local subsidiary is just 1 or 2% of the group? So no local recovery plan is in place.
Ooh, that's a good question. For us, with international insurers, we have the other way around. We have one big one, which is quite international, NN Group, of course. So I look at big chunks in that sense. But it's of course possible that you have some small subsidiaries in other countries. I'm not sure how this would be picked up, if it would be in the public interest to apply resolution, or if it's to be expected to apply resolution to such a small entity. But then again, we probably need to see this in a cross-border perspective as well, with the colleges to come. So I'm not sure how this will be picked up, and I could imagine that it could differ for each situation here, depending, for example, on the critical functions they perform, or But it is not automatically that if you have a top 1 resolution, a top 1 insurer in the in country A, and a small subsidiary, that the subsidiary will be placed into resolution because it's a subsidiary of a big group. Hope that helps.
Anything else to add, or should we divert our discussion perhaps to who takes ownership of a preemptive recovery plan in an insurance company? Is it the risk function, perhaps? That would be the obvious one, or the CRO? How would it work in practice?
So on recovery plans, I have a personal view. If the recovery plan is hidden in a box, it's not a preemptive recovery plan. It has to be wedded into the risk management system. If it's got indicators that are in a box, they're not indicators, they're a piece of paper, it needs to be wedded into the risk management metrics. So to me, the CRO and the risk function has to take this job on. I don't see how it wouldn't. Maybe we can share experience in Ireland. We actually have preemptive recovery plans for many years already, and it is the risk function that does it. Sometimes it's very close to the ORSA and can be confusing, and sometimes it's a little bit in parallel to the ORSA, and I find that sometimes more useful, because getting your board of directors to work through an ORSA with you as a risk function, and getting your board of directors to work through a preemptive recovery plan with you as a risk function is a slightly different mindset. But Irish experience, the risk people won. So all the actuaries in the risk function, well done.
Yeah, it's quite similar here.
Yeah, and I think it's maybe just saying that sometimes I think, and this is something that obviously we haven't had the requirement here in Finland, but anyway, the recovery actions might there might be quite strategic actions also, selling of businesses and so on, and somehow I think it's also needs to be a strong idea, at least from the board or the senior directors, that this would be the way to go. Also, if there are key stakeholders or owners, there might be some kind of a thinking and approving of these actions. So I think you need to involve a lot of people around.
Seems like a lot of people would be involved, but naturally risk function holders and the risk function would be the natural place of settling this, or most of the work relating to this. We have a few more minutes, and perhaps we can discuss anything which you think is more important to point out. From your perspective, what would that be?
Yeah, maybe we can take just a short closing words, and let's end up in timely. So maybe just Mike, what would be your kind of maybe final words and suggestion? What would you suggest actuaries and AE members to now start doing?
I think the IRRD is not up for negotiation, it's a fact. So either do the mathematics and see if you're in scope, or ring your regulator and see if you're in scope, and create a project team.
Thanks. Arjen.
Well, I think some insurance company will find a resolution framework a burden. Well, in my opinion, it's important to have it, not because I'm happy to wind down all kind of insurers, but because I believe that having such a framework in place and thinking about what happens after I die would help to prevent dying. So yeah, I think it reduces the risk for society as well.
Okay. Thank you, Arjen, and thank you, Mike. And on IGS, as told, this is something that we are now trying to deal with within the AA, and we will come out with kind of ideas in this regard. With this, I would certainly like to thank Mike. A lot of really good presentation, a lot of understanding. Really big thanks to Arjen for building up the resolution. The process, the thinking, the valuation. We learned a lot from you today. Thank you, Stefana, for guiding the Q&A, and we had a good discussion. Thank you, everybody who participated and being active. I think this is something that you will have on your table. Hopefully, we're able to provide good kind of thinking, good substance on this matter. So with this, thank you, everyone, and have a nice working day and a week.
And Lauri, perhaps I think it's worth noting here that the AAE is putting together a working group on IRRD, and we're trying to recruit volunteers. Mike Claffey will be leading that group, so we would be tremendously grateful if anyone reached out to us from this webinar interested in joining our work and helping out.
Thank you, Stefan. Thank you. Okay.
Thank you, Lauri.
Have a good day, everyone.
Thank
you. Have
you.
a good day. Bye-bye.